I'm Harriet Greenen from City AM, and we're here to talk about IFAs. Out of interest, who here is an IFA? Which is why we're talking about it. I'm going to let the panel just introduce themselves, because I think it would be useful for you to have some context as to what they all do. Ceri, would you like to kick off?
Hi, I'm Ceri Williams. I am from RateSetter.
Hello, I'm Iain Niblock. I'm the CEO of Orca. We provide research on the P2P space to retail investors and, as of this morning, to financial advisors. So we aggregate data, we conduct loan-by-loan cash flow analysis, and we standardise the metrics for comparing one investment against the other.
I'm Julia Groves from Downing Crowd. Downing's a 30-year-old EIS VCT investor who finally adopted crowdfunding.
I'm Jake Wombell-Povey from Goji. We provide investment administration services to peer-to-peer platforms, helping them with their innovative finance services, and also launching a series of investment products aimed at the wealth management sector.
Good afternoon. My name is Richard Wazacz. I'm the CEO of Octopus Choice, and we have built a peer-to-peer platform that's allowing financial advisors and their clients to invest in residential first charge secured asset-backed loans, and they seem to like it.
Julia, I know you were keen to kick off and talk about why this is a problem at all. Why are we talking about cracking the IFA market when alternative lending is already matured and there, and we're all here talking about it?
Yeah, I mean, we are a £10 billion market already, and I guess it's just I got my first insight into how difficult it is to be an IFA and how to consider any form of alternative investment over the last year. Really, since the retail distribution review, there's been a challenge around the degree of suitability checking an IFA needs to do. And what that means in terms of the wealth set they can deal with. So we know we have about 5.5, 6 million people in the UK who can't afford financial advice. But even for those who can, the IFA needs to, on the one hand, look at the full range of what's on the market. But on the other hand, the level of due diligence they need to do on a loan-by-loan basis is almost impossible. So I think it's just time for us as an industry to try and find ways to help solve some of the problems so we can reach the inflection point and have them flick from thinking it's kind of not worth it to actually it is.
So this is about making life easier for the advisor. And Ceri, if I can get you to pick up on this, because at RateSetter you've very much tried to do that by making RateSetter accessible by building in an advisor offering. Can you talk a little bit about your thinking behind that and what response has been like?
Yeah, I think response has been, I would say, low to medium. We started sort of bottom up, so we recreated what a normal lender on RateSetter would get, with the added advantage of them being able to put a fee in and they could administrate it on behalf of the client. So it mimics very much exactly what a lender sees. The rates are the same, everything is identical, it just offers a few more tools. So it works. We tried to recreate, in fact, sort of what you'd see on an investment platform. As an IFA, the fundamental difference is it's only got a single asset in it, which is RateSetter. So that's probably part of the problem. But it's not really a problem in terms of we've had good take-up. The ticket sizes in terms of the account sizes are just bigger. They're about 5 times the size of our normal lender accounts, which is a good sign. I think our issue is there's education, there's all these sorts of things. I think a lot of financial advisors are possibly used to buying unitised standard asset products. We're not unitised and we're not a standard product, so that's a bit of a fly in the ointment. But one thing that we're seeing more and more over the last certainly the last 6 to 8 months is that I think the emergence of people like Downing and Octopus, they've really, really helped us because they've actually opened up the opportunity to us, probably without them being, unintentionally from their point of view. But I think one thing that people are seeing now from financial advisors is this is a way to protect client money against inflation pressures. And as long as they can preserve client assets against inflation, they've, broadly speaking, done their job.
Richard, can I bring you in there? Because you go on Octopus Choice website and it says advisor very clearly. What have you found has been that response? And do you feel like there has been any kind of cultural shift within the advisor community?
So, I don't know how many of you know, Octopus is a company that's been around for 15 years, and it's very much been brought up and built on advisor relationships. So the business has become, the market leader in niche tax-efficient products, and we recognised that we had a really strong asset was our distribution with advisors. So we work with about 3,500 financial advisors, and we've built up a brand and a trust with them, and we've built up a brand and an awareness where we're regarded as a business, I think, that helps make complicated things simple. And advisors tend to be very risk averse and very cautious of new things because they're looking after their clients' money. They've got a real obligation. They've got a real requirement to do the right thing. And doing anything that no one's ever used before, that's a big risk for an advisor. So I think one of the things that's helped us, and I was not involved in this, so I inherited it, and it's made my life easier, is that when myself or my team have gone to meet advisors, they even let us in through the door, which is really hard. So, and I recognise that with some of the, fintechs, building trust is really hard. So that's helped us massively. Then it's all about trying to help an advisor give good advice. And there's various things that we do to do that. The first thing is advisors need to satisfy themselves and their compliance team that they've provided good suitability. So we do a lot of independent due diligence on our platform using third-party agencies that we provide to advisors to say, look at what these people have said about us. They've come, they've looked at our loan book, they've looked at our lending. Then you want to make it really easy for the advisor to engage with you. So we've built a platform that allows advisors to manage a portfolio of clients and their assets, allows them to charge in an RDR compliant way, so taking upfront and ongoing fees from their clients. And it's about trying to make this easy to use and being very transparent so that the advisor can use it. So we've been going for about 9 months with the advisor space. We've got about 200 advisors using the platform. About half our funds under management, so coming up to 50 million, has been generated from advisors. And the way I look at it, and we've launched products before, it takes 2 years to get real traction. So we're not, we're hoping we see the hockey stick in another year's time. But what we need is we need more people in the market, because the biggest thing the advisors are saying to us is we really like this asset class. It sits somewhere between cash and equity, lower volatility, more security, understand the liquidity risk, but can I compare you with someone else? And I think what we're almost saying is to other platforms, you've got to persevere at this. You can't build IFA trust up quickly. You've got to just work at it and work at it and work at it and really invest the time and the effort.
We've had a question come in which I think is probably pertinent here, because you mentioned helping make it easier for advisors to put their charging structures in place. Can an advisor justify charging fees for peer-to-peer? When any of us can go on, and this is an industry that has sprung up from opening up accessibility and allowing people to, to access without having to go through an IFA. Is there a friction there?
I think you're talking about whether people should use IFAs or not. So I've gone on record before to think IFAs have a really valuable place to play in the market. I know there's some IFAs who are creeps, cowboys that rip off their customers. But most IFAs do their job because they want to help their clients. And they need to make a living, and they need to charge people for that. And people are scared to look after their money. People are uncomfortable doing things with their money. That's why they have an IFA. I think the question we asked is, who here is an IFA? Who here uses an IFA would be more interesting. I suspect a lot of people here do use IFAs, and you pay your IFA a fee because your IFA is helping you plan for your retirement, give you comfort that you've got the money and the resources that you need so that you can live the life you want. So if an IFA goes out and does some work to work out whether this peer-to-peer opportunity is right for you, and he keeps monitoring it and telling you whether to put more money in, take the money out, he can justify his fees. But that's a personal relationship between the client and the IFA. So some people would balk at paying an IFA for that, do it myself. But some people value it. And I think that's a contract between the client and the IFA, and it's for nobody else to go and comment on.
But there's no way the 10 billion in the market so far has come from people who do not have an advisor. The early adopters are the more confident, more sophisticated investors who have advisors. They're just not using them for this purpose. And from our perspective at Downing, a lot of the early money which came into the bonds, so we do debt-based securities, so every individual offer is at least £1 million. That means a totally different level of due diligence and disclosure and independent reports than you would get elsewhere. Now, that works in our favour because the IFAs really want to see that level of scrutiny because they feel they need to look at the individual end investment and get comfortable with it for their client. But at the same time, we have a lot of IFAs who are saying, look, this is sometimes just cash. The returns on cash are so low currently, and we wouldn't be counting that in our portfolio. So if people are moving cash into peer-to-peer lending and debt-based securities in the knowledge that they're moving up the risk curve but also the yield curve at the same time, at least it's in our purview and we can see what they're doing. Because otherwise our level of influence is going down all the time as people do more and more alternative investments by themselves.
And can I bring in Iain and Jake here? Because, Iain, I think it would be really great if you could tell everyone about the product you've launched today, because if we're talking about putting more information in front of advisors, putting research in front of them, analysis, let me
I think when you talk to a group of IFAs, you get some IFAs that just are never going to touch P2P in the present day. They're just very hesitant. They're used to very standard products. And then you get some IFAs that understand it to a certain degree, and you explain about peer-to-peer lending, they start to get it, they can start imagining how they would incorporate in their client's portfolio. And these are the IFAs that we're really trying to target, the early adopters. We've launched a service today where we aggregate the P2P providers. We've standardised the metrics to allow them to benchmark one P2P provider against the others, so they can make sensible decisions. And then further to that, they can download reports and save that for due diligence purposes as well. When you talk to an advisor, they're very restricted in what they can do by the compliance requirements. So we need to make that as easy as possible for them, and that's what our service aims to do.
In terms of the Goji product, this is why I think it's so the IFA for us is not just about the fact that there's a very big addressable market. It's not just about the fact that potentially the lender is getting a better net return and possibly the borrower is getting a lower cost of finance. It's the signal that this is now mainstream and here to stay. And I think for us, it's the point where even the more reluctant IFAs are beginning to say, I can't say that I'm doing the whole of market unless I know what an innovative finance ISA is.
Yeah, I'd agree with that. The IFISA is certainly helping to bring it mainstream, and it's helping to just build that awareness, that education with the financial advisor space. But I think we've got to be really important here that we don't kind of tarnish the entire advice industry and the entire, I suppose, investor population as well by saying this is something that everyone should be using, every advisor should be using. There are some advisors who do a fantastic job providing, very low cost, very accessible services to their clients by focusing on very mainstream, very low risk products. And equally, there's part of the market that the end investor is interested in IFA, in P2P. They understand the risks. They want to get that sort of return, and then they want to move out of cash. And equally, there are wealth managers who are saying, look, I want to do that kind of that gold-plated job, and I want to go outside of the mainstream. I don't want to just use kind of large listed funds. I want to start, advising on, tax incentivization, inheritance tax. How do I start getting a liquidity premium for my client by moving into things like direct lending, peer-to-peer. So the IFISA was absolutely critical for that because, so my little brother works at the largest wealth manager in the UK, and they've said something like 75, 80% of their inflows come through tax wrappers. So trying to get that into the financial advisor market without there being a tax wrapper, and you obviously can't get them into SIPs at the moment, that's increasingly difficult. It has to be the IFISA. And frankly, every conversation we have with an IFA, you kick off by saying, by the way, you can get this in an ISA. And on Richard's point, that typically enables you to at least get through to them on the phone. So I think that's going to be the start, really, of what hopefully will be an increasing but gradual journey of adoption amongst them.
Do we think that the innovative finance ISA is going to put increasing pressure on the sector? I mean, and this is what we all heard a year ago, but obviously it's been a bit quiet while approvals have been coming through. You've got 80 billion subscribed to 13 million ISAs in 2015.
Yeah, I mean, well, I could stick pencils in my eye purely on the basis that we haven't got an ISA yet as RateSetter, but I'm heartened by the fact that the industry appears to be getting that full regulatory piece, which is great. I think IFAs will, that will move the needle a bit on IFAs, but it'll move the needle on the rest of the community too. I think our biggest hope as RateSetter in the model that we've got at the moment, and who knows, that might change, and I'm interested in trying to change that to a degree, is that we go after the retail customer, and our hope, our model suggests that the retail customer is going to want to invest in peer-to-peer lending, and they're going to persuade their IFA that that's where their money can come from now, or that's where, the IFA should place money into peer-to-peer. That's what's worked for us so far, and I don't think it's an amazing model, but our model is very much based around the end user. So we've built the IFA bit just purely because IFAs asked us to, or some did, and we were hoping that overnight it would just wash out, but it hasn't worked that way. We work hard for every penny from an IFA, but quite right too. We get paid too, so why not? So. But I think the ISA will give people more reassurance that the FCA actually take this sector seriously. But that is about it.
The challenge I'd say with the ISA is that it's typically a very seasonal investment product, and I think if you look at the majority of platforms that do longer term lending, for them to get 50% of their funding potentially through the ISA season of March and then April, and then try and deploy that over the other 10 months of the year, I think that can be quite challenging. I think a lot of platforms have got to think really hard as to how do they manage that kind of mismatch between supply and demand.
There was an implicit question in there about scale, I think, though, as well, Harriet. So what happens if this alleged wall of money arrives? Yeah. And it was really important, certainly from our point of view, that if ISA was opened up to debt-based securities. Because, the average size of the bonds last year were around sort of 2 million. So we do many, many fewer deals than a RateSetter would do, but they're much larger in size. It's also moved beyond companies into charities as well. So I think that broader proposition will help the industry scale so that demand can be met. But I wouldn't want us to rush too quickly. There's a lot of debate about whether equity should go into the IFA. And the conclusion eventually was not for now, because ISA is a brand, and rightly or wrongly, people have a perception and understanding of what it was. It's an individual savings account. So I think we have to assume that the majority of people start with kind of savings in their mind, and we don't want to rush too far up the risk curve, because people could very easily, just particularly the unadvised, feel it's going to be safe because it's in an ISA.
Someone's asked whether regulators are doing enough to facilitate the education of IFAs around alternative finance. Who would like to pick that up?
Yeah, my perspective is, I don't know if it's the job of the regulators, companies like ourselves coming in and really getting the boots on the ground, providing the white papers free of charge to drum up the interest in the sector, to go out to speak to them, to tell them about peer-to-peer lending, explain about the risks and the rewards, give them a free tool and try and bring on and educate the advisor community. So I don't see it as the regulator, I see it as more, our role at the moment.
It's absolutely our accountability to educate both retail investors and IFAs about this opportunity. Just an observation on the IFA. Most IFAs take advantage of tax wrappers at the beginning of the tax year because they know that they're planning, they're not doing it as a last minute thing. So I think that seasonality issue with advisors, because that's kind of what we're trying to focus on, isn't going to be such an issue. A good advisor will take advantage of tax wrappers as soon as he can or she can. And in terms of education, that's down to us. So one of the things we've done is we've run CPD seminars and have accredited thousands of IFAs now in the UK, so they at least understand what the P2P permissions they have let them do. And just us doing it once isn't enough. Kind of got to do it 2 or 3 times, got to meet them 2 or 3 times before they'll really start to consider it. But this is a slog. This is a slog, a big investment of time and effort, but it's worth it.
Also, just the date you deposit the money has to be about midnight on the 5th of April, you then can, at your leisure, start to choose whatever loans or bonds you want over the course of the year. Now, you don't want to take too long, because the chances are you're not being paid a very good interest rate for that money on deposit. But you don't have to rush at the last minute and pick everything. You just have to deposit the money and then begin to pick the loans and build a portfolio over time.
Jake, you might like to pick this one up. Does it matter that we don't have a multi-platform ISA?
Well, so actually this came out last year, and Goji certainly, and I know with a number of the trade bodies, was very, so yeah, we're pretty noisy about the fact that as it stands, only the P2P platforms can be the ISA manager, and we politely pointed out that if that happens, you will only get single platform ISAs, and the whole, the industry is trying to put forward a very mature argument around how this is good for financial inclusion, and also this is low risk, and this is a sensible financial product. Diversification has obviously got to be at the heart of that. And that doesn't necessarily mean to say diversification is easy. As we found out, and some of our competitors have found out, it's very difficult to actually try and build a portfolio or an aggregation capability amongst peer-to-peer platforms. And that's both because of the regulatory structure of a P2P loan itself. You're not dealing with a share or a unit in a fund. It's also to do with just, frankly, this is a whole new asset class that isn't settled through stock exchanges or clearing platforms. So trying to build all that market infrastructure as well is a challenge. And then, frankly, it's dealing with a large number of customers, a large number of product providers at the same time. The challenge is huge. But as Richard mentioned, it's, I'm certainly sat here because I believe it's one that's going to be worthwhile, and the opportunities there. But no doubt we'll see, a lot of innovation development in this space as people find new and interesting ways of getting what is ultimately a fantastic financial product, but getting it to the investors in a way that meets their investment objective, rather than saying, here's a P2P loan, why isn't everyone investing in it? I think that's the translation challenge that certainly platforms like Goji are trying to help advisors and investors to overcome.
One of the sort of complaints that you hear certainly from fund managers, is that the sector hasn't been through an economic downturn. What is the response to that? How do you combat that when it hasn't?
Well, it kind of has. So I don't know. I mean, depends which way you watch that. Zopa were founded in 2005. They put up their returns during the financial crisis earlier on in the day, and Jaydev's slide pointed out that actually people still made money. I mean, they certainly made a lot more money than they did sitting in a bank account, put it that way. So I don't know. I mean, fine, you are making an investment, it's not a deposit, and I think the FCA have spent a long time, they've certainly spent a lot of the last 3 years trying to work out whether, how do they get it across that you are actually making an investment here and this isn't a deposit. However, the industry want to say this is a kind of cash-like product. So I think there's a bit of a conflict there, and I haven't answered that question particularly well, but I actually think it's a complete red herring.
Yeah, I think if you explain as well about peer-to-peer lending as an asset class and get them to understand that, that the peer-to-peer loans are not sitting on an exchange, they're uncorrelated to the market. So 2008, Lehman Brothers collapses, it affects the FTSE 100 massively. I mean, it wouldn't have that direct effect on the underlying assets that you get in peer-to-peer lending. And when you actually explain that to an IFA or a retail investor, they kind of twink like, oh yeah, that is kind of correct, and they can understand it. But again, it's back to that education piece.
I think one of the more credible concerns is around interest rates. A common question is, what happens when interest rates go up? Surely they can't go any further. I mean, in general, my view would be that, when interest rates go up, the cost of borrowing does at the same time. And I would love to think that the banks will just pass all of those rate returns on to the savers, but in reality, they won't. But it's what makes if I say, even more relevant, because, bugger all tax-free is still bugger all. So if you've got something you can have tax-free, it's really a complete waste to use it on cash, which goes from 0.7% to 0.5%. And I think that's one of the reasons why we're seeing so much movement in this last window for people coming in.
A final, how are we doing for time? A final area I think it would be useful for people to hear about is the idea of robo-advice. Yeah, and robo-advice now is used from everything from ETF portfolio builders to financial chatbots that sit in your Facebook. And obviously, Ceri, you might like to pick up on RateSetter's partnership with Plum, just to give people some context of what this can look like and why it's relevant to talk about robo-advice when we're talking about advisors.
Yeah, I've got to be careful here. I mean, Plum doesn't actually offer you any advice. So it's a bit of that's just a mechanic thing.
Yeah.
The way our platform, Jake alluded to it earlier, that you're buying whole loans here, so the way money comes into our system, it actually it made it easier for people through e-wallets, so coming through, stuff like Mango Pay. It just makes it easier to come through our IFA portal purely because you can have a single ownership or a single administrator and multiple accounts underneath. That's really just the way our system's built. What it does is it gives us a new distribution channel. So I think, I'm still going to be here, hopefully, that is, charging around looking for IFAs and dining out on Richard and Julie's success, hopefully. But the point is that Plum is just an efficient way of managing, administrating stuff. It does not give you any advice.
I think sometimes P2P and robo-advice get grouped in, both as these kind of new age financial concepts and therefore considered a match made in heaven. But and I'm not disagreeing with that necessarily, but I think it's important to remember that what we're seeing with the advent of P2P, marketplace lending, etc., is investors being able to access an asset class they never were able to access previously. And what you're seeing with robo-advice is how all financial products are distributed to investors. Mm-hmm. And so whilst I think there's scope here for innovative businesses like P2P platforms to I suppose, innovate to that robo-advice and that distribution, I don't think we can necessarily start saying, things like Nutmeg, for example, why the hell aren't they enabling me to invest in all these other platforms? The reason they are very cheap and the reason they are such, they see the robo point is because they can work really well with large established exchanges, fund platforms, ETF providers, all those sorts of things to give investors really cheap access. If you suddenly wanted to do that for P2P, you could see platforms like Nutmeg, building 50% of their platform again just to build out to access quite a niche asset class. And then you've got to ask yourself the question, are we really giving the investor the best possible scenario, or are we actually just trying to kind of overhype innovation here? So I think we've got to be careful. I absolutely would love to see, all of these asset classes going through increasingly sophisticated robo-advice channels to serve those kind of underserved and those financial orphans. But I think we've got to be careful what we wish for and concentrate on building really quality, financial products rather than trying to tag on to more and more, I suppose, waves.
There is a midway point, though. There is the in-between. So what we see very commonly with the IFAs, apart from just putting their own money in and their wives' money and their children's money, but not being a bit too scared to recommend anyone else, it is possible to do financial planning with the client and say, given your situation, your portfolio, you might want to take 10% of your money and put it in something like RateSetter or a funding circle. Off you go, pick your own loans, fill your boots, without actually choosing the individual loans for them. And in that situation, it's easier for them in some cases when they're worried about compliance and worried about professional indemnity. And every IFA is different. Some will do that, some won't. But because it's outside RDR, it's not a retail investment product, they can still earn commission regardless of whether they pick the bonds or the loans or not.
So if we're talking about, whether we're talking about advice or we're talking about planning and we're talking about automating that to some extent, should IFAs be concerned?
I think the term robo-advice is unfair on financial advisors in general. So if you go on a robo-advisor online, it's a very simple, slick process, but really what the value of a financial advisor is adding is the personal relationship and understanding of more of a holistic view of their finances. So do I think that the advisors should be scared? No, I think that they should concentrate on what they're good at, and that is the personal relationship which they have with their clients.
That very much. Richard.
Yeah, the financial advisor is not going to be disintermediated in this country for a long, long time for that very reason.
Totally disagree, because I think there's a whole generation of people who don't trust them. I think that when you say what the robo-advisors do isn't very impressive, it's a bit alarming when actually that's what the IFAs have been doing for a long time. So I think there's a generation of people who can't afford them. There's a group of millennials who won't trust them. And they're pretty depressed as a bunch of people when you go and talk to them. So I think that there's many who are looking at selling up and getting their book out of there, because it's almost impossible to make any decent amount of money post-RDR with the suitability requirements unless you move up the scale to the super wealthy. And I hate anything where it's just the rich getting richer and the poor staying poorer.
And on that note, we are out of time, but thank you very much to our panel. And
Thanks. Thank you.